We'll be going over IRS Form 8825, rental real estate income and expenses of a partnership or an S corporation. So if you handle real estate rentals for a living, you might be familiar with reporting your income and expenses on Schedule E of your individual income tax return. That's the supplemental income form that reports things such as rental real estate, distributions for partnerships, so on and so forth. So that is on the individual income tax return side. If you are a partner in a partnership, or if you are an S corporation shareholder, then you would need to complete a different form, IRS Form 8825. So you go through very similar calculations as you would on Schedule E, and we'll go over that in a moment. However, this is the form that you would complete, and then the results of this form feed into your into either your Form 1065 or your Form 1120S, depending on the specific business entity that you're a part of. So we will go through kind of the step-by-step details. I did want to cover a couple of items about this form. So according to the instructions, partnerships and S corporations use this to report income and deductible expenses from rental real estate. This includes any net income or loss from real estate, rental real estate activities that flow through from estates and trusts and partnerships. So the form instructions on the IRS website specifically say that you should be somewhat familiar with passive activity limitations in the instructions for Form 1065 or for Form 1120S, specifically for the definition of rental activity. And then the second thing is you should be aware of any extraterritorial income exclusion items in the form instructions for your respective tax return. So each form comes with enough space to report on 8 different properties. So we're on page 1 of the form, and you can see A, B, C, and D. That would be for the first 4 properties that you choose to report on. We'll go through that momentarily. On page 2, identical fields for items E, F, G, and H. So if you need to report on more than 8 properties in your S Corp or your partnership, you can file an additional, you can report on as many different Form 8825s as you need to. But when we get to the crucial, the total income lines, you're going to report on that on exactly one form. So you'll go through lines 1 through 17 as many times as you need to for as many columns and as many forms. But once you get through to lines 18A through line 21, we're going to consolidate everything in one return. So we will not be reporting any of the following on Form 8825. Income or deductions from a trade or a business activity or a rental activity other than rental real estate. So like renting personal property out, for example. Those items would be reported elsewhere, and that's not in the scope of this form. You would not be including portfolio income or deductions. You would not include any Section 179 expense deduction. You would not report any other items that are required to be reported separately to partners or shareholders. And finally, you won't be reporting on any commercial revitalization deductions. That's verbatim from the form instructions. So now that we've completed all of the background, let's go through this form starting at the top. So as you can see, the very top, the name of the taxpayer would be the business entity, not any individual. So our hero, John Doe, is completing this on behalf of Doe Enterprises. He's got the taxpayer ID number or the employer identification number at the top right corner. And then he is listing 2 properties on this form. So we'll go through the requirements where you list the physical address for each property, street address, city, state, and zip code, the type of property, which is annotated by a single-digit code. We'll get to that in a moment. And then fair rental days versus personal use days. So you can use some of the guidance that is in some of the other IRS publications about use of your personal residence. For example, when it, some of the guidelines on when it would be considered a fair rental availability as opposed to personal use. We'll lightly discuss it in that if a property is listed for rent, then it can be considered fair rental use, even if it's not actually occupied by a tenant. Whereas personal use days are pretty obvious. So in this case, we don't have these units are fully rented out for the entire year. But let's take a look at what this type code means. So fortunately, at the bottom of page 2, we have allowable codes for type of property, and they're listed 1 through 8. So single family, multifamily, vacation or short-term rental, like an Airbnb, for example, commercial property, land, royalties, self-rental, and then other. And you would have to include a description with code 8 on either the form itself or on a separate statement. So we have properties that are listed as codes 1 and 2, which means that this property located at 123 Main Street is a single family residence, whereas the property on 2000 Main Street is a multifamily residence. In this case, as I was drawing these instructions, I was imagining a 4-unit apartment or a fourplex. You can kind of draw whatever conclusions you have in your mind. So as we noticed, the single family residence is listed as item A. So all of the items under column A will pertain to that particular property, whereas the multifamily residential property is listed in row B. So it will be all of the income and expense items will be annotated in column B. So these are all numbers that I just pulled fictitiously out of my hat, but there are a couple of things here. So there aren't a whole lot of notes in the form instructions. There aren't a lot of specifics. So we kind of went over line 1, which was the type of property. But the only other specific mentions of any other line items would be interest expense deduction on line 9, and then depreciation and amortization on line 14. So again, those just refer you to either IRS Form 8990, which is the business interest limitation calculation, and then IRS Form 4562, which covers depreciation and amortization. And we'll put links to those in the show notes. So the purpose of this is simply to help kind of illustrate some of the possible expenses that you could be deducting from your tax return or from your properties. So creating the article about this, I did borrow a decent amount from the relevant IRS publications, specifically when it comes to IRS publication 527, which goes over use of your residential rental property. And let's see, IRS. Sorry, not. Oh, that's basically it. That's what we used. So IRS publication 527 is the one that covers residential real estate. And again, if you're not expert on what expenses can be considered, then it would be a good idea to work with a professional tax preparer, especially if you need bookkeeping. A lot of tax professionals will do bookkeeping and then will make it easy, make it easier to report these items on your tax return because they're keeping track of your expenses year round. Now, if you're going to do this yourself, I would highly advise that you at least keep good track in whatever bookkeeping software you use, and then kind of go over items that you may have questions on with a tax professional, even if that person is not preparing your tax return. So there are tax professionals that specialize in managing taxes for landlords and rental real estate professionals. I definitely highly encourage that. So we're going to go through really quickly. Line 2 would be the gross rents. This is a pretty obvious choice here. In this case, $30,000. That averages out to be $2,500 a month for the single family residence, and then $160,000, which comes out to $40,000 per year per unit in the 4-unit complex. So advertising expenses, you can list those. These are all types of expenses that you can list. And again, these are not numbers that I pulled from another form or schedule. I simply rounded to the nearest thousand for all of these for easier calculations and for you to visualize how this would look. So advertising could be online postings. It could be, advertisements, Facebook ads, things of that nature. For those who still may use classified ads in whatever newspaper still exists, you can certainly use those. Anything that is required to actually get your property listed, you can use as an advertising expense. Auto and travel, you would need to be a little bit more familiar with the rules of auto and travel. So, for example, if you're managing properties from off-site, your travel expenses would be covered. But if you're driving around in your local area, then your mileage, you can either use standard mileage rate or actual expenses. That is outside the scope of this video, but you would only be able to include expenses related to business travel, not personal use of your vehicle, and not commuter travel. So if you work out of an office building, for example, your drive to and from your home to the office building is not considered business travel. It would be considered commuter travel. But from your office building to any of the properties or business conducted on behalf of those properties, that's fair game. If you have a home office, then you could possibly document things properly so that you're commuting from your home office to your residential properties, site visits, things of that nature. You could possibly claim those. Again, that's a scope of a different video. Let's see, cleaning and maintenance. So if you're managing an Airbnb, obviously you're going to be paying some cleaning fees with the turnover, or you could be doing maintenance. So those are deductible expenses as well. Commissions would be deductible in certain respects. So if you are paying a commission to, for example, a property manager or a real estate agent that's getting your property rented, then that would be a legitimate commission that you can pay. However, mortgage commissions, if you got a mortgage through a mortgage broker and there's a mortgage commission on your closing paperwork, that's not included. Sales commissions as for the purchase or the sale of a property, that's also not allowed as an itemized expense. both of those would be capitalized expenses that would add to your basis, and then you would depreciate those over time. In line 7, you can enter the cost of insurance. Generally, this would include homeowners insurance or commercial property coverage. So property and casualty insurance or liability insurance coverage would be covered here. If you bought a property, title insurance or mortgage insurance would not be considered a deductible expense here. In line 8, you can deduct legal or professional expenses to include the cost of tax preparation for your entire business return. So the cost of filing this, the cost of filing your Form 1120S or your Form 1065, those would be legitimate legal or professional expenses. Additionally, you could also include any expenses that you may have paid to resolve a tax underpayment issue related to a rental activity. So if you had to go through this with your tax preparer and you calculated an underpayment, and then you had to kind of work with that tax preparer to resolve the issue, you could also include any fees above and beyond just your tax return preparation. Line 9 includes interest. This would be your deductible mortgage interest for each rental property. You should receive a copy of Form 1098, which is the mortgage interest statement. However, they may be subject to limitation. You would need to complete IRS Form 8990, which is the limitation on business interest expense under Section 163J of the Internal Revenue Code. In line 10, you would enter the cost of repairs. So repairs versus capital improvements, this is kind of a big deal. So repairs would be things that are not intended to provide a substantial increase to the value of the property. So if you had to replace it, if you had to repair a broken window, that would be a repair, not an improvement. However, if you replaced all the windows in your house and upgraded them to hurricane resistant windows, those would be capital improvements. So that, same thing with air conditioning repairs versus replacing your air conditioning, things of that nature. So you have to capitalize the cost of improvements as part of the property's basis. So you eventually get the tax benefit through the tax avoidance when you sell your property down the road. Taxes in line 11. So you can enter the cost of state or local taxes. You can't deduct federal taxes or tax penalties. You also cannot you cannot include any taxes where there is a substantial benefit to your property. For example, some property owners live in Florida where we have what's known as a community development district. Those are, a lot of people think of those as taxes, in that there is an assessment and a payment. However, CDD fees may or may not be includable depending on what the purpose is. So you would have to be very careful and very particular about, taxes that are incurred to improve properties. For example, like a special assessment for, road repairs would not be allowable. But, taxes based on the value of the home, that would be allowable. Utilities, you can enter the cost of utilities that you may have provided or paid for the rental property. Wages and salaries, you can include that. We did not. So if you paid staff like a property manager in-house wages or salaries, you would include the cost there. In line 14, depreciation, you may need to calculate this on IRS Form 4562. So you can claim a depreciation deduction each year for rental property. However, you cannot depreciate the cost of land. So you will need to kind of walk through that calculation to make sure that you're accounting for it properly. And then other expenses, I was not able to really find an IRS reference that listed other authorized expenses. But if you did find an expense that's includable as rent as part of your rental real estate costs, you could include that there. You would annotate the type of expense over here and then enter it in the appropriate column. So now that we've listed out all of our gross income and all of our expenses, we're simply going to add numbers up. So in line 16, we're going to add all the rental real estate expenses in lines 3 through 15 for each column. In column A, we've arrived at 18,000. In column B, we've arrived at 37,000. In line 17, we're going to subtract these amounts from the line 2 amount up here. So 18,000 from 30,000 is $12,000 in net profit. Over here in column B, 160,000 minus 37 grand equals $123,000. So now that we've got the total for each columns, we're going to switch and we're going to take the total of the rents in these columns right here. And again, this is where if you had more than one sheet, you would consolidate everything into one. So columns A through H, but implied would be on all forms 8825. So in this case, the total rent is $190,000 for the year. That's these two numbers combined. The total expenses is $55,000. That's the sum of 18 and 37,000. In line 19, we're going to enter any net gain or loss. These are capital gains or capital losses from IRS form 4797, which is the sales of business property form. So let's imagine that we sold a rental property during the year, took it off of our portfolio, and we netted a $5,000 gain. We would include that here. In line 20A, we're going to enter any net income or loss from rental real estate activities that have been passed down to this partnership or S corporation from another pass-through entity. This could be another partnership, it could be an estate or a trust, but it would be reported to you on Schedule K1. So let's imagine that Doe Enterprises right here is let's say that it's a partner of Smith Enterprises. You would enter the amount of the income or loss, and then you would enter the name and the employer ID number of that particular pass-through entity. So there's enough room in here for up to 3. You could attach a separate sheet of paper with additional entities and EINs as necessary. And then in line 21, we're going to combine lines 18A through 20A. So in this case, this is 190,000 minus the 55,000 in expenses, plus the gain from the sale of the rental property, plus income that was reported to us from a Schedule K1. And we arrive at $150,000. This would be entered on either your Form 1065 or your Form 1120S, Schedule K, Line 2. So we do cover this in a little bit more detail in our article. Specifically, if I could find references in the IRS instructions elsewhere, I made sure to make notes of that in the article. And if there were forms that were mentioned, we do have links to those forms as well, articles that we've created on those forms. So if you want, you can check out our website. Simply go to teachmepersonalfinance.com, type in IRS Form 8825, and you should see our article appear. So if you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. If you have any questions or comments, or if there's something that I can help you with, please post your question in the comments section, and I'll see how I can help you out. Thank you very much and have a great day.